variable overhead 6 shillings per unit. The selling price is 40 shillings. So we are given additional information, projected sales and the production units. Information is provided as follows. So in our case here, we are given the projected sales in units from the month of July all the way to the month of December, all the way to the month of December. These are the units which the company projects it will be able to sell. And then you're given the production. So these are the units which are like the company projects it will be able to produce. And then from there, we are given the variable overheads. And the variable overheads are paid in the month that they are incurred. And then you're told the fixed overheads are budgeted at shilling 700,000 per month, which include the depreciation. Remember, we say that depreciation, this one is an non-cash item, So when preparing the cash budget, we don't consider the non-cash item. In other terms, we don't consider those particular items of incomes or expenses which do not give rise to a cash inflow or cash outflow. So in our case, when considering these fixed overheads, we will have to exclude the depreciation simply because it's an non-cash items. And then number 4, we are told wages are paid 75% during the month in which they are incurred or basically earned, that is, and 25% in the following month. Number 5, material costs are paid 2 months in arrears. So in other terms, the material will be paid after 2 months, in arrears. Number 6, a tax liability of 1.4 million to be settled in the month of October. 7, a new van will be purchased in the month of September 2024 for shillings 2 million. And then you're told the current motor vehicle shall be sold in the month of November 2024, and it is expected to fetch shillings 300,000 from a prospective buyer. And then number 8, we are told the cash balances at the month of August 2024 is expected to be 1 million. And specifically, we are told that this is the cash balance at the end of the month of August. Automatically, this cash balance at the end of the month of August shall be the opening balance in the month of what? In the month of September. In the month of September there. And then you're told the business makes a monthly cash sales of 50% of the total sales in a specific month, while the remainder is on the credit, which is settled 1 month after the sales. So what are we required to do? We are required to prepare the cash budget for the month commencing 1st September 2024 to 31st of December 2024. In other terms, you're required to prepare the cash budget for how many months? The month of September, the month of October, November, and December. So that is a cash budget for how many months? For 4 months. For 4 months. So maybe in this case, I don't know whether we have some few workings we need to do here before even we can proceed to prepare our cash budget. Let's see whether we see whether we have some few workings which we need to do before we can proceed to prepare the cash budget. But remember, in this case, we said that the first thing you should even be able to remember is the format of the cash budget. Remember, you said when preparing the cash budget, always we have the details column, and basically columns equal to the number of months. If you can remember the question which we did in class, we prepared the cash budget basically for 12 months from January all the way to December. But in this case, we're required to prepare cash budget just for 4 months. The month of September, October, November, and December. So we need to have basically how many columns? 5. The total, the details column, and basically columns equal to the number of months. And then from there, we start by recording the opening cash balance. We record the cash receipt or the cash inflows. And then after that, we record the cash the cash outflows. So maybe we can see which expenses or maybe which workings we can compute. Now here, we are told this company, which is called 𝐍𝐶𝐈𝐍𝐄, basically produces and sell a single product, which is called a product K. and we are given the details. So these are basically the production costs. So for the company to be able to produce that product, the company incur direct material cost, direct labor, variable overheads, and the selling price. Maybe in this case, we can have some few workings here. We can have some few workings even before we proceed to prepare what is required. Maybe we can start by computing this particular variable cost, because in this case, I think in point 2, we are told variable overheads are paid in the month they are incurred. Which are the variable costs? The variable costs are basically these costs which we have here: the direct material, direct labor, and the variable overhead. So I think what we need to do is we compute the variable overheads. Let's have that as the first working here. As the first working here, the variable overheads. Or I don't know whether we, instead of having that here, can we have that working within our cash budget? Yes, let's do that. Instead of having separate working, because remember he said this particular working, for example, in an examination setup, will just be consuming a lot of your time, but basically by the end of the day, they are not marked. So maybe I can have that figure here. The direct material cost is 5 shillings, and then the direct labor cost will be 10 shillings, 10 shillings, and then in this case, the variable overheads will be what? 6 shillings, and then the selling price will be 40. So any working which basically is required, we are going to do it per need basis. We are going to do it per need what basis? Maybe first of all, let's come up with the format of our cash budget. I can basically borrow this one here. I copy. So we require to prepare the cash budget. We require to prepare the cash budget here. The cash budget for the month of September all the way to December. So I'll basically be able to copy all these months. I'll copy all these, and then I'll have them here. So I'll basically paste. So those are basically our 4 months, September all the way to December. So what do we start with here? We always start by recording the opening cash balance, Then below that, we record what? The cash receipt. I hope you can be able to remember this. The cash receipt, in other terms, is said that this can also be known as the cash inflows. The cash what? Inflows. The cash which is flowing into the business. Cash flowing into the business. And then down here, I will have the cash payments. Yes, maybe I think that space is enough. I'll have the cash payments. Cash payment. So the cash payment, in other terms, we also refer to this as what? The cash outflows. The cash outflows. Yes, equally in this case, we can also be able to bold this one. Yes. So I think we can go straight to this information which we have in note number 1. Note number 1, we are basically given the projected sales, or the sales, or the units which were expected to be produced and sold. So this one will help us in terms of computing a number of items down here. I think we can start with the note 2. Variable overheads are paid in the month which they are incurred. The variable overhead basically, I've said, are these 3 costs here: the direct material, the direct labor, and the variable overhead. So what I will do, I'll basically copy all these, because these are variable overheads, or the variable costs. So I'll copy all this. I basically bring that here. Remember, once the company pay for some expenses or some overheads, that is a cash payment. I'll basically have that here. I'll paste that here. Okay, so let me redo that afresh. I'll copy Ctrl+C, and then I paste it here. Huh? What is happening? What is happening here? Okay, so let me copy. I don't know why this one is not moving. I copy, and then I paste it here. Okay, let me copy this one. I see whether it will be able to move. Okay. Let me first of all maybe move it to, I arrange this on the right. Because we should be able to move without basically typing. Remember, you see that whenever you're doing these particular questions in an examination setup, you should avoid a lot of typing. A lot of typing will basically be consuming a lot of your time. Maybe I can arrange all this. I arrange this on the right. Let me see whether it will be able now to move. I copy. Yes, it's now moving. So I copy this one. I basically paste it here. Yes. So, but I'll be able to do away with this information about the cost per unit. So what I'll have here is the direct material cost as a variable overheads. Equally here, you'll have the direct labor cost. I'll then have the variable overheads. The variable overheads here. Yes. So now having this, I can be able now to proceed and basically compute the variable overheads. I will start with the direct material cost. How do I compute the direct material cost? To compute the direct material cost, I will take the direct material cost per unit, which I'm given up here, which is basically 5 shillings. And then what will I multiply this with? Do I multiply this with the units which were sold or which are budgeted to be sold, or the units which are budgeted to be produced? When computing the variable cost, we base it on which units? Unit to be produced, unit to be sold. Unit to be produced, unit to be sold. We base this on which unit? Yes, this one should basically be based on the units to be produced. On the unit to be produced. Yes, we are going to base this on the unit to be produced. The unit to be produced in September are these ones. So I will enter. Then I will do the same for the direct labor cost. I will take the direct labor cost here, and then I basically do what? Multiply that with the unit to be produced, which is 180. And I hope up here I've used, let me see what I've worked with. Yes, I think this one is wrong. This one I need to correct this, because you can see I've used the unit to be sold. I should not use the unit to be sold. I should use the unit to be produced here. Yes. So then the variable overhead in September, I will take the variable overhead per unit here times the units to be produced, these ones. This one. It is also important for you to see what you are told in note number 2. The variable overheads are paid in the month they are incurred. In the month they are incurred. So the direct material cost for September, and also the direct labor cost and variable overheads for September, they were paid in that month. They were paid in that what? Month. They were paid in that month. Then what I'll do, instead of basically repeating all this, I'll be able to apply my formula. But if you check, for example, if I drag my formula here, automatically you'll know it will not work. Because what Excel will pick, Excel will be able to pick the value we have here across, and equally it will take this figure across. You can see in these other cells, do we have values here? No. So basically, in computing this cost here, this direct material cost, basically there is something which will not change. This direct material cost per unit, this one will not change. So therefore, I can do this. I can just lock this one. Okay, even before we do that, can we pick this particular formula, we apply it across, we see whether it will work for us. Is it working for us? No, it is not working for us, because what Excel is picking are this particular unit to be produced, but also picking the figures in this cells. You can see these cells are blank. So what I need to do, basically what we need to do, we need to lock what is not changing. So what is not changing here is this one. This one will not change, but now Excel will be able to pick these others. So I can lock the value in E3. I shift $. Okay, I shift $, and then I shift $, again here, and $. So let me see whether, okay, there is a problem with we have a problem up here. This one should be $, like that. So let me apply that formula. I see whether it will be able to work for me now. Let me apply that. Is it working for us? Yes.